Hello folks, Steve Lynch here with Discover Options. Welcome to this presentation of 3 different market reports for the S&P 500 for advanced options traders. This will be for Friday, June 22nd, getting ready for Monday, June 25th. Presented material is for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All 3 market timing reports pertain to the current market condition, and we define that in terms of 3 different dimensions: price action, the trend, and then the stochastic situation. So in terms of price action, Thursday was a downswing bar, followed by Friday's action, which was an inside bar. All right, that's just a 2-bar piece of price action there that occurred in the context of an uptrend. We're definitely above the 50-day simple moving average. Now, we take that combination of price action and trend, and now we look at the stochastic situation. And the stochastic is right around 52, so we're going to define it as being between 30 and 70, and we're underneath the percent D, the 3-day simple moving average of the 15.3 stochastic. So all 3 dimensions combine for a market condition that has occurred roughly 49 times since January of 2000, and that's because of that inside bar. I mean, out of over 4,600 closes of the S&P 500, this particular condition has only occurred 49 times. And that's because, again, because of that inside bar that occurred after the downswing bar. So with that said, this being the current market condition, let's go and look at the butterfly Condor report, answering the question, is now a good time to put on a butterfly or condor campaign and initiate one in the S&P 500 cash options? Okay, so here's how the report goes. We've had 4,653 closes of the SPX. Of those, 65% were favorable bars for selling option premium using these strategies, because the actual, in these cases, the actual 21 bar movement moving forward was less than what the SIBO skew adjusted VIX was implying, the option prices. Okay, so once again, 65% of the time in the S&P 500, 65%, almost 2/3 of the bars are favorable for selling option premium, because the subsequent 21 bar movement, actual movement of the index, is less than what the option prices are implying. So you're getting fatter premium than what actually transpires. So also during that time, our current market condition has occurred 49 times, as I mentioned. Now, of those 49 occurrences, 63.2% of the bars were favorable like that. That's less than the benchmark of 65 by about 1.8%. So we have a premium selling edge technically of a negative 1.8. So statistically, it's technically more likely than usual, looking at the past, that our current market condition will end up being an unfavorable one for market neutral option premium selling. Can you still make money? Absolutely. You could still put on these strategies and have some of that 63% come to pass, and that's great. It's just that the benchmark, you can flip a coin and do a little bit better. Okay, so that's what that means. It's 1.8 negative. It's not a huge deal, but just be aware that there have been better conditions, certainly, where the past has, as you look at the past, it would be more favorable in other market conditions than this one. So let's now go to the bull put spread timing report. This is for those that like to sell puts, either naked or perhaps through a bull put spread, where you're at the end of the day selling out of the money put premium a standard deviation away 30 days out. That's the premise here. All right, so as I mentioned, we've had 4,653 closes of the SPX. Of those, 82.9% were favorable for selling put premium like that, where the actual 21 bar downside movement was less than what the SIBO skew adjusted VIX was implying to the downside. Okay, so almost 83% of the time the market does not move down and hit that one standard deviation level where you're selling those puts. Okay, that's a good thing. 82.9%. You can flip a coin continually, and almost 83% of the time, you're going to land on a favorable bar for doing this. Now, as I mentioned, our current condition has occurred 49 times. Of those 49, 85.7% were favorable. That's more than the benchmark of 82.9. So in terms of the market condition as it applies to a bull put spread strategy, we have a apparent premium selling edge of positive 2.8%. Okay, so statistically, it's more likely than usual that the market condition we have now will end up being a favorable one for selling that out of the money put premium. Finally, let's go to the market likelihood report. This is where we're looking at the broad market and looking at 5, 10, and 15-day rates of change, as well as the realized volatility. So let's go to the very top. Take a look at this. We have since January of 2000, 4,656 closes of the S&Ps. On average, you have a 5-day rate of change of 0.1%, about 1/10%. So since Jan of 2000, the market's gone up. On average, you can take a 5-day period from one close to the close 5 days later. You'll have roughly, on average, 0.10 or 1/10% of an increase. Makes sense because the market's gone up a lot since then. Then your 2-week rate of change, okay, about 1/5%, and then a 3-week rate of change is almost a 0.3%, it's well over 1/4% change from one close to the one 15 days later or 3 weeks later. Okay, so that's the benchmark rate of change. Now, we're going to go to our current market condition, and here we counted 49 incidences. Of those incidences where our current market condition occurred in the past, of those, okay, your average 5-day rate of change is at almost 0.5% to the upside, 0.49. Okay, if the benchmark is 0.1, and then out of our 49 occurrences, it's 0.49, that's a difference of 0.39. That's a lot. That's quite a bit. So how significant is that? You would think that maybe it's just hugely significant, but when you look at that in the context of the standard deviation, okay, that's not even a 1/2 a standard deviation to the upside. That's what this z-score means. It's a measure of significance. So is that 0.39 difference significant? Well, it's about almost 1/2 a standard deviation to the upside, which is something to take notice of. We'd be a lot more excited if it was a full standard deviation to the upside, but we just take it for what it is. Now, the 2-week rate of change is a little higher than the 1/5% at 0.26. That's a z-score of only 0.055% of a standard deviation to the upside. That's not a huge deal. The 3-week z-score is at 0.21. Okay, but the important thing here is that you definitely have it leaning to the upside and not the downside. That's important to note. Now, what we like to do is divide those occurrences, here those 49 occurrences, we divide those in half, well, roughly in half. Those where the market went up above the previous day's high, in this case Friday's high. If Monday it goes above Friday's high, we're going to take a look at this. Or it could go down below that inside bar's down, the low that we saw. Okay, in that case we have down here. So in those 32 incidences where the market went up above the high of that inside bar from Friday, okay, you have the market definitely going to the upside. Okay, over a full percent over 5, 10, and 15 days. Z-score of almost 1.25%, 1.25 standard deviations to the upside. That's huge. The 2-week z-score to the upside, almost a full standard deviation at 0.81. 3-week standard deviation or 3-week upside is at 3/4 of a standard deviation to the upside. Very significant here. So if on Monday the market goes above the high from Friday, Okay, good chance, judging from the past, that the market will continue to the upside. Now, if the market goes down below Friday's low, that occurred 19 times in the past, and in that situation, you have a short-term upside z-score of 0.14 of a standard deviation, 14% of a standard deviation, not that big, but look at this, okay? The 2-week move was actually 0.25% to the downside, or a downside z-score of almost 40% of a standard deviation to the downside, and then 1/5 of a standard deviation to the downside on the 3-week. So a mixed bag if it goes to the downside below Friday's low. On the upside above Friday's high, the picture is pretty clear. Now, in terms of volatility, the benchmark volatility for the S&P is between 15 and 16%. Okay, that's an actual annualized volatility level. Okay, for our 49 occurrences, we have a realized volatility level in between 13.5 and 14, which is underneath the benchmark realized historic volatility. And then you can see the breakdown in terms of where the market would go if it goes above the Friday's high or below Friday's low. Still, roughly between, well, 13 and, gosh, look at that one over there, almost 15% there. Definitely below the benchmark realized volatility. Now we compare this over here to our VIX number, which is at 13.77. We're right in the ballpark there. We can't definitively say that given these realized volatility levels that VIX is mispriced. It's right in the meat. Interesting though, when you look at the 9-day short-term VIX at 10.84, it's quite a bit underneath what the realized volatility levels are on an annualized basis. So looks like the short-term VIX, VIX is definitely undervalued relative to what will eventually come to pass if history plays itself out. Okay? Thanks so much for joining us. I'm Steve Lentz with Discover Options. Have a great week trading. Bye-bye.